Hello, Warriors. How's everyone doing today? Hugo, Paul, how are you? Mustafa, nice to meet you. Hello, LZ. Welcome to Face. Let's take a look around. We have a lot of data today. Everyone knows we have the ECB. Hello, Sinatra. We also have CPI and jobs numbers. Okay. So this is triple bearish ETF on NASDAQ that, was able to ride up here. So this is the key on, here's my look on Euro. So it looks like we've had one failed attempt, two failed attempt. Maybe what we're going to do is fill out this triangle a little bit. Get rid of this. Going to take it to about 20 and a half, which were some of my targets from last week. And you can tell on the daily, yeah, the solar eclipse, maybe the market peaked on that. It was an annual. So you have some moving averages coming in and right around that area. Low Monica. Okay, so you have moving averages coming in at 2082. Okay, that would take out this low. And I don't know if we're rounding out a top. I still think we're going to make new highs. And I know the dollar is frustrating some bears here, but I'm still looking for the 89.20 level from January to be taken out. Looking for about 8860. I'm really paying attention to Euro Aussie since I'm more bullish Aussie than Euro, and thinking we had almost attacked the 61.8 level. I'm thinking maybe this line up here. See what happens after the ECB. If it works out for the Euro, maybe up around the 158 level for a short. Aussie holding up the best. That the Q was on Friday, but I still think it's a little early to only try and buy 38% correction here. I'd be looking more for 50 or 61.8 in the coming days. And I do want to point out this in the VIX, even though it's a shade lower. We did make new lows for the move here this day. Took out these lows. We're having these uh, ghost trades. Everyone remembers silver before it bottomed. Would come in. Thank you, LZ. I'm stopped out BE on the other half. I took half and got stopped out at 62. Actually, a little surprised how weak gold is with the yen down. So why don't we get to that? So we'll see. I mean, this still could be a pullback here in gold. In fact, it might even be worth a shot here, but I'm going to stay flat until the news is out of the way. I really don't like trading during central bank action. I like to react to it, but I don't like to position myself in front of it. It's more of a roulette bet for me than trading, where you could throw away your chart. So, what to do is to have all your technical levels all lined up, and then after the news, see if any of them are tagged and react and execute. So, that's what I'm planning on doing today. Oil is starting to act a little heavier. We'll see if we could get a failing rally here. We diverged up here on multiple time frames. I know some people looking for 71. It's a possibility. So, I'm short from right around the 70.10 level, 70.01. So I'm BE here. I'm not looking for a home run ball, but just some type of correction. And this could be a failing rally that we have here. So that's something, I don't think will be that affected by currency, more affected by risk. And, the S&Ps are, is this a top? They're trying to tempt me to be afraid. Okay. Well, you could join the community, Jeffy, and there's, plenty of ideas and entries. They put out patterns in play to help you with entries. So that would be my suggestion, is to become a subscriber here. Okay.
Good morning, Dale.
Hey, Blake, why don't you take over?
How you doing?
I'm doing okay.
Yeah.
Yeah, I was just looking at, oh, we can't talk about weather or strippers today. I forgot. Yeah,
Talk about
so
what?
weather or strippers. Yeah,
Oh.
yes.
Well,
So,
that's what happens when you talk about
yeah,
strippers. Is
yeah.
that?
So,
So
what
hey,
are your
we,
expectations, guys?
you were just talking about taking or having positions on going
Central
into
bank.
like central bank decisions. I've been long this Euro Aussie for like I don't know, going on 2 weeks, and it's one of those that I know that if volatility picks up, it's gonna rally, and it came out of this triangle, and I've been long basically at the 156.80 level for
Oh, it's a nice
forever.
look. Yeah.
Yeah, I mean, this is just this is like it's like any day now, but I didn't want to just close out the position being it's profitable just in case the euro ripped. But I came into today hedged because the other setup that I've been looking at and took advantage of a couple of days ago was the euro yen, and the euro yen breaking down from the ascending wedge. So I went into today both long and short euros, but hedged. And the way that trade would actually work out,
You
both
lift
trades
one
would work
leg.
out, would be risk off. So
Okay.
if for some reason the stock market started to roll over, those would both work out, just because the way that the currencies react in this environment. But it also gave me a hedge going into ECB, because if I had a wild euro drop, and it doesn't mean we can't get one here in 20 minutes, I would have obviously some exposure. If the euro spiked up above 123, I would have exposure. So I don't mind being hedged going into. I guess what I'm trying to say is that was an example of me being in
And a
euros
flat. Yeah.
flat into a central bank decision. Just giving you a live example. Hopefully it makes sense to you
Okay.
guys. But one of the things that I wanted to talk about is we did get a little bit of a move following the ECB decision. Now, nothing's changed. Everything stayed the same, but we've got to wait for Christine Lagarde and the ECB press conference here coming up. I'm going to let Stelios talk a little bit about the ECB and their statement. But what I also wanted to mention, if you guys didn't, I just tweeted out this video, and it's right here, and it's regarding I tweeted out. I'm going to take this on. I'm going to put the link in our chat, and this is for everybody, so you guys can watch it. This is the daily roundup. For our Forex Analytics subscribers, it's the daily roundup from yesterday. So yesterday, just so you guys know, I'm gonna tell you a little bit of what I did yesterday. Yesterday, I filmed a video for everybody. Really, it's more education. It is the 5 worst traits of a trader, or the 5 worst trader traits. There's obviously way more than that, but it's the top 5 in my opinion. And one of them was holding on to losing trades too long. And I filmed that video yesterday, and in I filmed the video yesterday, but in the daily roundup, which I was talking about, like what was happening in the euro and, ahead of the ECB and blah, 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 blah. We got in a really long discussion about, we got in a long discussion about what had happened, or what had happened in that video and what I was talking about. And I pulled out the statistics from Justin Hertzberg over at Forest Park FX. I mean, I had a chat with him yesterday because I'm like, okay, we had an interview with you a couple weeks ago. You told us these numbers and he gave me the numbers. He showed me the numbers and I was like, holy crap. I mean, I knew traders held on to losing trades. I knew it. I know it because look, I've been in that situation. I'm like, oh, that's a great, and I was talking about the example yesterday of being long euros on this breakout. And I'm like, oh man, I'm so convinced that the euro is going to 125. I'm going to hang on to this trade. And then next thing you know, 3 weeks later, it's trading down at 120. And you're like, as it breaks down technically, and you're like, what the hell? That's exactly what happens. And I go into great detail yesterday in that video that I just put in our chat. I go into how that happens. But when you see the numbers and then you see it with your own eyes, it's very staggering and it's very eye-opening. And I had to get that out to everybody.
I have a great headline for that video.
What is it?
How scalpers become investors.
Yeah. Well, that's the old analogy we use. You go from
everything. I'm old.
Yeah. Well, we would always
use old things.
When I would teach like a live event, like at a in a hotel, because before GoToWebinar and before Zoom, we just did stuff live, like at a Hilton hotel, and there'd be like 100 traders come in, and I'd teach them for 2 days, and
that was fun.
What's that?
That was fun.
Those were fun, actually.
Yeah,
I miss those days.
I miss that.
Quite fun, because then you put your computer screen on a projector and everybody could see your computer screen. Then I would just talk everything out. But I remember I'm like, don't let this happen to you. Don't go from a day trader to a swing trader to a position trader, because after a position trader you become a religious trader, right? Everybody just prays to God. No, even the non-religious people will pray to God that things turn around. And that's a fact that happens, and it's happened since it's always
the
happened.
Dawn of time.
It really has, because egos get in the way. And anyway, you guys watch the video. I tweeted it out this morning via Twitter. I put it on. I just put it in I put it in the chat box, and and I want to say that's. And I mentioned this yesterday, and there's a video that's coming out. It'll be out probably by this weekend. It's called The 5 Worst Trader Trades. You guys have to watch it, because if anything, it's a very real reminder to all of us. It's one of those things, and I'm going to tell you from personal experience of the last 25 years, I have definitely fallen off the wagon and gotten into bad places in the markets, because that's what happens. You trade and you're doing great, and then all of a sudden the market turns and you start making bad decisions. At that moment in time, that's when you need to break out the video I just filmed that you're going to be able to watch this weekend. It's free. It'll be on, just follow us on Twitter or YouTube or whatever. Watch that video, and hopefully it'll set you straight. And that's having that tool or that education in front of you. Like, dude, I am in a slump. I need to watch this video. And then you watch the video, and hopefully it's like, oh man, that makes sense. Okay, let's get back on track. That's so important, guys. And that's why I wanted to take a few minutes and talk about it. But for starters, just to get your appetite wet for what's coming, watch that link that I just sent you, that I just put in our chat box, of the video that I did yesterday, is the daily roundup. Again, that's for Forex Analytics subscribers only. When you to watch it live, but we put the video up like less than 24 hours later, so you guys can watch it. But anyway, I just want to talk a little bit about that, but let's also talk about I'm going to let Stelios and Steve interject here. Here's the euro, and I just want to talk about the ECB, and we have inflation data today too. Everybody I've talked to believes that inflation. They actually believe the Fed's going to be right. They believe inflation is transitory, but and right or wrong, that doesn't mean that we won't have stronger inflation data today. So just keep that in mind. Remember, we have CPI coming up later today. Market's looking for 0.4% month over month, excuse me, and year over year at 3.4%. And this is, I think you got to watch. Obviously, the year over year number, we all know it's going to be over 3%, but watch month over month, because this is the number that we'll be watching between now and maybe October, once the quote unquote transitory period takes place. But between now and then, you don't want these numbers getting too far outside of monthly expectations. So 0.5, 0.6% on a month over month CPI read is going to freak the market out, right? That's when people start going, it's not transitory. It's not transitory. So just keep that in mind. That's not it's not the only thing. The ECB is not the only thing, not the only game in town. This is the chart I'm looking at. This is the breakout point. I'm going to lay it out for you guys. This is easy. Above 225, we're probably going to I said 225. 125, we're probably going to 122.25. Shoot. We're probably going to head back up towards trend highs and maybe even a 123. Below channel support, look at this, this is a 200 period moving average on a 4-hour chart. Now, it's not anywhere close to the 200-day moving average, but keep in mind that this has supported the market just recently, with the channel. So we get much below, 120, 121, let's just call it 121.20. The euro is going to slip, and we'll probably see, the lower end of this range around the 120 level again. So, today is really set up for a breakout. I'm hoping, obviously, we all want some higher volatility here. I'm hoping a breakout occurs. So just keep your eyes and ears open today. Remember, it's not just the ECB. We have CPI data that's gonna potentially move the needle today. And then, then we're off until, then we head into Friday and another weekend. Anyway, just a little heads up. So I hope everything that I said today, is it receives you well. And that's it. Stelio, Steve, good morning, guys.
Good morning.
Hey.
Good morning, everybody.
How's it going?
I'm good. I don't know why you're preparing everybody for me going over the ECB, because they've done nothing.
It's big news, man. Big news.
No, actually, you know what? They're just affirming everything. So they're affirming the size of the PEPP program. I've lost count with the acronyms. They said they don't.
Yes, I did a blog on the PEP before something, which is I can't even. And the Fed's got like at least 8, maybe 10 acronym facilities in place right now. So
the acronym game started in 2008 to 2009, and it expanded ever since.
And it has. I mean, you're gonna run out of like combinations of letters to use. Anyway, Stelios, go ahead.
Yeah. I was gonna say, in true central bank fashion, they basically gave us nothing new. They said they don't have to use the full PEP, the Pandemic Emergency Purchasing Program, whatever it's called, but they can also increase it, and they're flexible regarding the time, the asset classes, the countries, etc. And they did affirm again that the rates are going to have to be at the present levels or lower levels until the inflation goal is near. The question is, what is the definition of inflation goal is near? Because it is getting to target now. So how much are they going to allow it to be at target or above target? Are they going to be like the Fed, who want a symmetrical inflation target? Are they going to wait just to be maybe on the safe side? I have a feeling they will do the same. They will try to prolong it as much as they can, but inflation is going up, and we're going to see this on the CPI today. We're expecting in US 3.4% year-on-year core CPI. Regular CPI, non-core 4.7% we're expecting. So that's, that's pretty high, and it's not just that it's high; it's that it's been increasing at an alarming rate over the past 3 or 4 months.
Can I just? I mean, I know everybody knows this. I was actually just talking to one of my very, very close friends who's a commercial real estate dude. He buys and sells like fast food chains, pretty much, like the real estate beneath them. You know what I mean? It's that's he buys it for clients or whatever. Buys and sells it. We were just talking about the housing market yesterday, and I just want you to know, like on my street, just on my street where I live, home values have jumped. Now think about this, like over 40% in the last 2 years.
Wow.
But there's no inflation.
Yeah, I mean, I look at, it's not sustainable. And we were talking about the moratoriums coming due here over the next couple months. That you guys understand that supply is very restricted right now because no one's selling. We're going through a pandemic, and the Fed said you can't evict, the banks can't foreclose on these homes. You can't evict people. All the people that would have lost their homes, they're not selling. So no one's selling. And so people that are trying to buy, there's no supply. And so we've seen this, big, jump in home prices as a result. People trying to take advantage of the low rates, they're all running in, and but this moratorium is going to be over, and then you're going to have people that are evicted. Then they can't run out.
I think that ends the end of this month.
Yeah. So it's you gotta.
Where are they going to go, and what landlord's going to take them?
Yeah, and so I'm the reason why I put that out.
I understand the sentiment, but there is the other alternative. What are owners that are renting, quote unquote, renting their houses to people?
Wait a second. Are you eating again, Steve?
He is again. I mean, it's.
Are you eating and talking again?
Yeah.
Your
like
mother
10,
never
10 minutes. 10 minutes of your life, man. Control yourself.
You see?
What are you? Okay, what are you eating?
No, I don't need to know that. I need to know that.
I want to know.
Pasta bolognese.
No,
there you go.
Finish your food, and then we'll have a talk. We'll have a conversation. I guess the point I was trying to make here is that when we're talking about inflationary data, or this is like maybe transitory, and I was just thinking, all these the housing prices, I do believe that they're going to moderate, and maybe price pressures all the way around. I'm just obviously giving you a small segment of the thoughts here, but maybe it is transitory. I mean, what do you think, Stelios? Because Steve is chewing on food.
Well, you mean for house prices?
What do you think about inflation?
I'm not eating.
I think inflation, the rate that it's increasing now is going to be, let's say, transitory. So basically, I think we're going to settle down to a lower level of inflation eventually, but it's going to be higher than it was before. So central banks eventually will have to do something. It's without doubt, because you're seeing the cost of raw materials, whatever this is, be it copper or food or whatever, it's all going up. Lumber, yeah, whatever. All going up, and you're seeing this in shops. I'm seeing shops here in Greece putting the prices up, and I'm sure it's happening everywhere. So when this happens, you get this translated in the cost of goods and services. So it's going to come into the reported CPI. It has to. So, and
this is transitory.
It is transitory. Yeah. I mean, this movie lumber was a bit ridiculous. This exponential rise, but look, it's the trend is higher, and it's going to be higher. So, I find it very difficult to believe that it's going to be transitory in the way that the Fed thinks.
Speaking of inflation and the housing market, I've explained multiple times the various different reasons with which they're toying around with the CPI. Another thing that I've mentioned at some point in the past is, rent used to be part of the CPI calculation. It's not anymore. You know what they replaced it with? Something called, if I remember right, owner's equivalent rent. So instead of having people report what they pay to rent, they have owners and they ask them, how much do you think you would pay if you had to rent your house to yourself?
Well, that's fair, right? Why go to the market and just
Yeah.
ask a random question,
Yes.
Whatever.
And that's how they replaced rent in the CPI calculation. Now, you make judgment if you think the end result is the same.
So
The one part that will not be transitory, one of the interviews last week was with one of the unknown market wizards, and he said wage gains, because you're not going to pay people more and then cut their salaries. At least most companies aren't able to do that. So he was saying that's going to be that's not transitory. That's going to be long term wage inflation. So once they raise wages, that's not transitory.
You should visit Greece. The way they slashed wages during this crisis the last few years, oh my God, ridiculous.
How about now? Do you have a shortage of workers like here?
No.
People and the reason is very simple, because they
didn't get as much money.
Exactly. We don't subsidize unemployment in a way that makes it the better deal. As simple as that.
Well, you have for decades, though, haven't you?
No, not unemployment. Other forms of
social welfare.
Yeah. Yes, but not unemployment. Unemployment was never really paid well.
Hey, guys, I know it's we got Dave Keller coming on here momentarily. I want to point out that you look at like crude oil, and this has nothing to do with what you're talking about, other than I was just kind of scanning some charts as you guys were chit-chatting around. This is early in the day. I know crude oil is up right now. We're up at the highs of the session, but it's early in the session. By the end of the day, this could be telling us a completely different story. If you negate yesterday's or today's candle, you put in, just look at yesterday's candle, right? This is, if we get some sort of reversal here, we're coming close to the 127% extension, and we almost basically reached the minimum triangle extension. And a lot of times you fall short of these extensions because, everybody's got the same target going. So if we reverse today by the end of the day, which is entirely possible, this is setting up for an evening star formation. So just a little heads up, because what we've seen in crude oil, and since we were talking about inflationary data and I was looking at some commodities, we are rallying in very divergent relative strength. So I think if you're bullish crude, just got to be a little careful here. Anyway, I just needed to interject before Dave Keller comes on. So
I'm assuming we're going to cover the data first, right, Blake?
Yes. 1 minute,
yes, we have to cover CPI.
Maybe very briefly, and then you can come up.
And then David will come on. Yeah. So we'll just see what the reading is. And matter of fact, what I will do is, since we are dealing with, I don't actually want to look at the euro right now, because anybody who's trading the euro is going to be waiting for the ECB and the press conference, which, will be starting now, but you got to really wait for more comments to come out over the next 10 or 15 minutes. So I think, ahead of this inflation data, you probably need to take a look at the yen, and we're going to keep a really close eye on the yen. One of the things about, I know you guys have seen this, but
look sideways right there.
Well,
just kidding.
You guys have seen a big rise in yields, or a big drop in yields, a big rise in bonds the last couple of days. Even Mark Faber, who doesn't, he's a macro dude that, obviously looks at the markets and he's thinking more bigger picture. He was even mentioning, he's like, hey, when we were talking to Mark Faber, what was it, Stelios, 2 days ago?
Yep.
And he's like, yeah, you got to, pay attention to this rise in.
Numbers.
Here's the number. What is
yeah,
it?
Stronger.
Month
stronger.
on month 0.6 versus 0.4, and the yearly core CPI at
Told you.
3.8, while the CPI at 5%. Good luck.
You got to watch this. You get this month over month number. That's a pretty stout number, and you can see the jump in dollar yen. So yeah, guys.
I'm really wondering what the real number is.
Double digits, no? Has to be.
Most likely double digit, yes.
Yeah. So, all right, guys. Well, hey,
they just spiked gold and silver.
Yeah. We're probably going to see the dollar, continue to, find some bids down here. Well, hey, Dale, have a great interview with Dave Keller, and guys, just real quick, because these are free webinars. If you enjoy these free webinars, make sure you visit Pepperstone Securities. They are our webinar sponsor. If you're outside the US or Canada, you want to learn how to be part of the Forex Analytics community, to be in our chat rooms, you want to be in there for free, open a Pepperstone account. You can get up to 4 months free of Forex Analytics. You have to open an account through here. And if you live outside or inside the US or Canada, or talk to Forest Park FX, because they'll teach you how to, and they'll help you get cashback rebates on your trades. And you can talk to them directly through Skype and email right here. Okay.
Blake, a fast answer to Paul. He says, you guys don't really cover the GBP much for some reason. The reason is very simple. It's been range bound within less than 150 pips for like 3 weeks now.
Wait a second. Paul, you must not know me very well.
He hasn't seen your video.
you must not. You must not know who I am. Here you go. Here you go, Paul. Let me go ahead and just send you this video if you don't know who I am, and then here you go. And then you'll know why I don't. Why I don't cover the cable at all. Anyway, all right, that's done. Jokes aside, the sterling, and just to answer your question really quick, and I cover that. Well, we cover everything on the daily or on the morning edge in about 45 minutes for the Forex Analytics subscribers. It's just, if something's happening, it just, sterling hasn't had much happening. I mean, I'm bullish while we're above this blue trend line right here. That means we could drop all the way back down to 132, 134, and I would still be a buyer down here. The only problem is like, what do you do with it over the last couple of weeks, or the last month and a half? It's like nothing, so. I mean,
hey, David's in the wings. Patience.
Yes, sorry. I'm going to let you take over. I'm just saying.
Enjoy the interview.
Moving.
Okay.
Yeah, have a great interview. Sorry.
Thank you.
Talk to you soon.
All right. Okay, David, welcome back to Face. How are you?
Thanks, Dale. I'm well. How are you guys?
It's okay. We like to talk here. So, every once in a while,
I was enjoying with everyone else. No worries.
Sorry about that, Dave. It was just inflation data came through.
Like on vaudeville, they would use a cane, a hook, or something to drag someone off stage. Got to do that once in a while, and me included. I'm a ham. I'm a natural ham. So anyway, it's not kosher, David. So it's great to have you back. And I'm curious what's on your radar, David. The action here has been quiet. Are we already in the dog days of summer? The ranges seem to be compressing. Is that a market tells you in any way?
I mean, when you think of adjectives you would use to describe the market, I mean, phrases like tired, sluggish, stalling, those are the kind of words that I hear myself using, that I hear others using, and I think that's totally accurate. And it's not just the directional trend. So if you look at the S&P, if you look at the NASDAQ, it's gone from an established uptrend to a decidedly sideways trend, right? I mean, we really made the push to new highs in April, and then we've stalled at that point. I mean, that's sort of the level. And for the NASDAQ, it's around 14,000 on the NASDAQ 100. On the S&P, it's just below 4,250. And the real question, as volumes have been lighter than average here in recent weeks, the question is, what's the catalyst? What's the, what's going to take control and push and push stocks higher if that's what's going to happen? And you have stocks like Facebook and Alphabet that look very, very good and are breaking out just fine. But you also have stocks like Tesla and Apple and Amazon, mega cap names that are at the lower end of their range, for the last couple months even. So that sort of indecision, that spread between what's working and what's not, is what's making the market sort of sideways right now.
So are we strongly neutral? You haven't heard that adjective.
Well, so I think for a while, I think the question has been less, is the market positive or negative? We love to simplify to bullish or bearish, and that's totally fine, because I think, at least having a binary, decision forces you to have an opinion. It forces you into one side. But to be honest, I think it's a question less about, are the markets in an uptrend, but what's the upside potential, right? What is the, what's the chance of a meaningful upside move from here? And that's where I would argue it's fairly limited. And you see that from, when you look at individual names, when you look at groups, when you look at things like semiconductors, which are, overall have been struggling on a relative basis in the last couple of months, that the market goes meaningfully higher when those types of names are rotating to the upside, not when they're struggling at the lower end of their range.
Yeah, I'm surprised that the market hasn't made more hay out of yields dropping from, back under 1.5, from we were in the 170s, and really hasn't made much hay with that, hasn't made much hay with a weaker dollar. I'm trying to think of catalysts in here, Dave, and the only thing I could think of is, no one thinks there's going to be an infrastructure, or there's doubt about the infrastructure stimulus. Maybe that could be a catalyst. Or we have the Fed next week. But what else could they say that could be stimulative to the market as they, get readings like they had today in CPI?
So that's exactly it, right? And in the absence of an upside catalyst, I think what we're seeing is that the market's really not able to move higher significantly. You mentioned yields, and I've talked for a while. I think that, if there was one chart to make sense of things, I think, it was either the 2s10 spread, the TNX, maybe the 10-year yield, the TLT,
10-year yield,
the bond prices. This is the spread between the 10-year and the 2-year. So it shows you the shape of the yield curve. So if this is going up, the yield curve is steepening. If this is going down, the yield curve is flattening. And if you look, the yield curve was really just accelerating to the upside through the first quarter, sort of sideways for the last couple of months, but just now breaking down for the first time since, summer of 2020. And that should be a headwind for things like financials, obviously.
Yeah, I was just going to say
built on that curve, right? So that coming down should be a headwind for financials. That makes sense, because if you look at the charts of Goldman and JP Morgan and a lot of the asset managers, they've had really, really good runs, and arguably could use a bit of a break if they're going to have a sustainable move after this. But again, bond prices have broken out. The TLT has gone to the upside. Yields have broken down back below 1.5%. Have you really seen the market dramatically blow out? As in, this is the all clear for growth stocks, and you're seeing it on a limited basis, but it's not a broad rotation back into growth. And to be honest with you, I think, remember, yields and bonds can move for a number of different reasons, but one thing is you could have just a rotation away from stocks into bonds, and potentially we're seeing the beginning of that rotation here, with bonds breaking out. But that would mean you'd have to see stocks breaking down, which you're really not seeing on a broad scale yet.
Yeah, I keep looking at that S&P chart, and it seems to, for people that are trying to time some type of top, they're probably getting FOMO right now, because I feel it too. I'm trying to sit on my hands for, a higher target up around 4,300 or so to see if we get there. I wanted to ask you about what you thought about miners, which have not really kept up with the price of bullion, which is kind of the opposite of how it should be. Normally, the miners lead, and gold has made successive new highs. And that gap that it left on the way down bothers me a little bit. What do you think? Is this a pullback to buy in the miners?
So, I mean, overall, I think so. I think the strength in commodities, I don't think we're anywhere near done with that. I think it was Blake just a little bit ago talking about oil. And I get, I mean, when I'm looking at the chart of crude oil, when I'm looking at most commodities, I'm seeing a broad uptrend. And the question is, are we in a tactical pullback or, and resuming the uptrend? And that's my sort of default way of thinking of this, just given the strength in that space. And I think the potential there. So you're right, though, if in a vacuum, if everything's kind of normal, you'd see the XAU, the GDX and others, really propelling and sort of leading on the way to the upside, but they really aren't. And I think the XAU is a perfect chart to be watching right now to sort of gauge that, because we hit sort of the August peak. We have this beautiful basing pattern, which is just a consolidation pattern between 130 and 165. We're right back up there. This is really close to making what we call a cup and handle pattern, which is a big rounded bottom and then a shallower pullback before we propel to new highs. And a break above 165 would really give the green light to that thesis. And, very simply at the very least measures up to 190 200-ish range.
Yeah, I concur for another high. A lot of things are moving sideways, and Ellioticians are calling a wave 4, which implies one more rally to the upside in many markets, including S&Ps, that this could be a 4 or a triangle and we get one more thrust. I'd like you to pull up, you brought up Tesla. And I've been writing and tweeting a little bit about Tesla, and I want to compare what I'm seeing with what you're seeing, because you're a licensed trained technician, and I'm just
I am a professional, Dale.
Huh? What?
I am a professional. You're right. Thank you.
You are. You're a pro, and and I'm just a runner that decided how I'm going to learn how to trade. So you have the same thing there, David. You have a descending triangle, and that the implications of that is pretty negative. And you have to say that Tesla was the meme stock before there were meme stocks, right?
Well, I was going to say, when you're looking at the chart of Tesla, when you're looking at the chart of Bitcoin, when you're looking at the ARK Innovation Fund, I would argue they're all showing kind of a similar story, which is, a number of new participants in recent years, and it's really accelerated, and they've gravitated towards sort of the meme names, right? Sort of these thematic plays, and Tesla was sort of the example before you started to have some others that are all telling a similar story. They've all had incredible runs, which is absolutely right. But then if you look at any of those charts that I just mentioned, and we're looking at Tesla, which is a perfect example, there's very little encouraging about this chart, I would argue, from a technical perspective. This is a classic rotation from accumulation mode on the first 2/3 of the chart to distribution mode on the right side of the chart, where
breakdown. Yeah, go ahead, David. I'm sorry.
No, I was going to say, so, what makes that the case is just, a couple of things. Number one, we've gone from a consistent pattern of higher highs, where every time buyers come in and, we break out, we make a new high from the previous one. That's what Charles Dow said 100 plus years ago, that's what an uptrend, how you define it. And that stopped happening. You now have Tesla making lower highs and all the other things that I mentioned. You're breaking support, right? So instead of holding the previous swing low on a pullback, you're starting to break it. And I think the tell for Tesla was right about here in mid-February, when you broke below the January low, you broke below the 50-day moving average, which holding the 50-day during an uptrend is sort of a standard, basic measure of, is this a long-term uptrend and just a tactical pullback, or is this something that's deeper and more, that I have to be more risk aware? And I think that signal there in mid to late February was the indication that this could be, deeper correction in terms of price and or time. And I think we're seeing a little of both here. The last one that I would mention, so the RSI is the second panel here. This is one of the best ways to measure this transition. If you look at Tesla sort of in the middle of this chart, you can see what a bullish phase looks like, where the stock's rallying, the RSI goes above 70. When it pulls back, it never really gets below 40. And that's sort of what a bullish phase looks like, right? Because people are buying in on weakness. The momentum never really gets too negative, and we go to the next high. Look at how all that changed about that time I mentioned in February. Now, all of a sudden, we're becoming oversold when the stock pulls back. When we rally, we're not getting above an RSI of 60. And that's more of a market in a bearish phase where, buyers aren't able to propel it to a to an overbought condition, meaning not enough buyers are really pushing it higher. So
also, go ahead.
I was going to say my overall way of thinking of something like Tesla, overall my bias would be lower. And I think you're right. You saw the descending triangle, which is a static support level, and then descending highs on the upper end. I've sort of indicated it with the trend lines. When you're looking at a stock like this, it's all about the pattern and then the trigger. So the pattern is a descending triangle. Absolutely right. That's confirmed. The trigger is a break below 550, which would take it below that pattern. It would take it below the lows of May and March. And I think if that happens, which I think it is going to, then that measures down to around 400, which would make it in line with these lows from the fourth quarter of last year. Make a ton of sense from a chart perspective.
Okay, good. It almost looks like from the low that you had in March and the bounce you had into April, that the same level of support happening in May is a much weaker bounce off major support and almost a fractal of what happened prior in March. The bounce that we're in from May.
That's exactly right.
I actually have a measured move. I mean, the whole formation looks to be $350 about, David. So I know you don't want to be.
So it depends on how you measure it. If you take just the height of the pattern, you're right. It sort of gets you down to the 300, 350 range.
Yeah. Okay. All right. So oils have turned into really being embraced. I saw Tom Lee on CNBC embrace them, said something like a hodl on oil, and people, huh?
They're using the memes on crude oil now.
Oh. Yeah, I mean, yeah. So I mean, they're really embracing WTI and saying that investors are scarred from it going negative, and really it's been an underperformer for a decade or so. It's a very small part of the S&Ps now. What are you thinking in here? Besides WTI approaching 70, any of the oil shares still look attractive after a run like this?
Yeah, it's fascinating. And I'm always looking for anecdotal evidence. My wife just mentioned yesterday that it was $4.20 a gallon for the premium gas around us in the Seattle area yesterday. And you're thinking of where that came from not too long ago, right? But when my wife mentioning the price of oil, that tells you we've had an acceleration to the upside, which is what we've certainly had, right? And if you look, if you look at the trend, it's a clear breakout pattern. Hitting the high earlier this year, rotating back to the upside, breaking above resistance. If you look at the continuous contract, getting above highs from the pre-sell-off in 2020, it's a pretty significant run. And what I like about the energy trade, and I think there's more upside to those names. I mean, they've had really good runs. This is the XLE that we're looking at. They've had really good runs, but still, I don't see anything on the chart to be upset about or to be cautious about yet. Overall, it's holding up well. And I think if you look at where speculation has been, it's been elsewhere. It's been in clean energy. It's been in technology, communications names. You've not seen a lot of chatter talking about energy or industrials or materials, sort of the boring cyclicals, but that have had incredible runs. And so I think I like the fact that this is something where people are not used to seeing. A lot of investors that are just starting have not seen oil prices do what they're doing right now, and have not seen energy stocks be leadership. And I think that's what potentially gives it an opportunity to continue to surprise to the upside. And I see further strength in commodities, and I think energy is going to continue to do just fine.
Okay, well, the dollar, David, is just a shade off its January low of 89.20. And, I was always taught that during dollar declines that you should look overseas. Is there anything that you like with the dollar continuing to decline, even though I think we're much closer to a capitulation low than a dollar crash? Anything in foreign markets that look good to you?
Yeah, it's interesting. I mean, when you look at the chart of the dollar, the question when we talk about stocks and think about the upside potential, right? What is there limited upside in stocks? I think the inverse is what you could think with the dollar. I mean, you're coming off of a significant low in January. This could set up to be an incredible double bottom pattern where you find support around the same level. And the question is, do you have, what's the downside from there, right? If you break it. But I was also taught in my career, Dale, don't confuse the bottom of the page with support. so remember, the dollar could go lower, right?
I've been, dazed and confused doing that. So yeah, all right, that's a great one, David.
But so I mean, I've always taught things in uptrends assume that they will need to continue until proven otherwise, and the dollar's in a downtrend until I see evidence of a rotation higher. I have to assume that the path of least resistance is down, and I think, as you mentioned, that what that would suggest is, non-U.S. markets should be looking pretty decent here. And overall, if you look at the average market, if you look at India, if you look at Germany, France, now a lot of that is obviously the weaker dollar that's making those look so attractive, but the charts are pretty good. And these ETFs that I'm showing, by the way, a lot of the iShares ETFs, this is how many US based investors would make plays on some of these non-US markets. So it has certainly a dollar impact in there, but I think that's how a lot of people would get exposure. But I'm seeing a lot of charts that are fairly constructive here. Brazil is arguably one of the better ones, and the EWZ again, it's similar to the XLE charts. It's the energy chart that we were looking at. And in the short term, it's overbought, which is it's been a nice bounce, a breakout of this base, which is really good. It's overbought in the short term, just coming out of that. So could you see a short term pullback? Absolutely, and I think we might be right at the time where you see that. But my question is that a tactical entry point on a chart that's overall very constructive? And I think that's how I would tend to treat it. Where you're seeing weakness, or we're seeing relative weakness, is in Asian markets, really. Japan was one that looked really, really good going into the beginning of the year and has stalled and has sort of just kind of come off. It's sort of floundering around sideways, but well below its February highs, while a lot of our markets are sort of at or near or breaking out to new highs. So I'm not seeing as much to appreciate on the chart of Japan. And then China, this is the FXI, which is a common China ETF. Overall, well off the February highs, really has been in consolidation mode for the last 2 months. And the way that I think of a chart like this, by the way, is it's all about a range-bound environment. The FXI is between 48 and 43.50 or so, which was the low from last month. And the question is, at some point, we break out of that range. Do we break out to the upside, break above 48? Do we continue to go lower? And again, I have to assume that the path continues lower until proven otherwise, until you get some sort of higher low that confirms that the downtrend has abated. But the relative strength being so negative tells you why it's been a tough market to get exposure to.
Yeah, right, most people wouldn't think that. I mean, they recovered from COVID faster than anyone. They still have the fastest economic growth. Everyone's so worried about China. Maybe they should look at the FXI chart and compare it to the S&P, and maybe they wouldn't be as worried. I'd like to wrap it with a little bit on crypto, and I'm pretty sure you probably follow GBTC, that trust. Do you, David?
Sure. Of course, yeah.
Follow any? I mean, it's hard not to follow it after what's happened over the last year or so. And I'm wondering, as a technician, we had a huge bull run, and we pulled back. Looks like we're starting to fill some gaps. Anything you see in this chart? I said yesterday Bitcoin actually had a false breakdown, and GBTC, same thing. You had that big gap. You had that gap down the day before yesterday, and then yesterday you gap back up. What's the message there? Is that an island?
So yeah, I mean, it's you call it a number of things. I'd probably just call it a hammer candle, right? Which is the open and close sort of at the upper end of the range in a long lower shadow. And think of it, and I like that illustration because you think of it as hammering out a bottom. That's we open at a certain point in a downtrend, we trade much lower, but by the end of the day, we've rallied back to the highs of the day, and it's about as bullish as it sounds, right? It shows that traders are accumulating. So in the short term, absolutely right. I think that's a nice bounce indication. I mean, if you look at the chart of Bitcoin, it's incredibly volatile, right? Which is an understatement. I mean, there's huge volatility that I think if you're used to looking at stocks or other assets, it's a next level volatility that you have to be mentally prepared for. But I do think that a lot of the traditional measures can still be very, very helpful. And I think that when I'm looking at the GBTC or I'm looking at Bitcoin, short-term bounce aside, overall, it's similar to the chart of Tesla in that you've seen a rotation from accumulation mode to distribution mode. You know, Bitcoin, obviously an incredible run up to 64,000 and then an incredible rotation lower. And I think for a lot of investors, the chart of Bitcoin is their experience right now, which is you're seeing a market that seems to have limitless upside. And then all of a sudden it changes to something that seems to have limitless downside. And that is a lesson that I'm sure you learned earlier in your career. And I know I learned. You have painful lessons like that teach you risk management and teach you how to bet size and teach you how to think about drawdowns. And I think for a lot of newer investors that are just getting into crypto and that's their introduction, I think this is providing some really good, this is the tuition you're paying to learn about investing. So
either pay to learn or pay the markets.
That's right. That's right. And I think with GBTC, the other thing to remember, I think for a lot of people have thought of the GBTC as just an ETF-like product to access Bitcoin. But if you look at the returns, I mean, GBTC has not really matched the returns of Bitcoin very well. And it rotated from trading at a significant premium to trading more at a discount. And so the returns were much more muted on the GBTC versus Bitcoin. So especially in the first quarter, had you owned GBTC, you weren't really gaining a lot while Bitcoin was up, 30-40%.
That's a great insight. So
and it happens with a lot of commodity ETFs. That's with the USO, with the UUP. There's this dislocation, and you're seeing that with this too. So I especially as people are looking for ways to access Bitcoin without having a digital wallet and all of that, I would just say make sure you understand the structure of them and look at the return profile. The charts are just look at the relative performance. You can see the return profiles.
Okay. Let me ask you this, David, and it's just theoretical. If you were looking to say you thought there was going to be a 10% or larger correction in the market over the even though maybe we haven't peaked yet, what would be your preferred way of capitalizing on it? Because there are a lot of ETFs that do not measure up to market performance on both the up and the downside. What would be your preferred way to take advantage of a bear market besides getting or a pretty large correction, almost maybe comparable to what we had during the COVID crash? How would you trade that? What instruments would you be focused on?
So it's a really, really good question, Dale. I am sort of having that in mind. If you look at the NASDAQ 100 recently, just in the year to date, you've had pullbacks of about 8%, pullbacks of about 12%, I think have been the two. The S&P has been a little less, right? About a 4.5% pullback recently, but earlier in the year, 4 to 6%. So how do you play a pullback that's that or even deeper, right? That you would retrace even further. There are a couple ways to do it. I think it depends on your risk assessment, how comfortable you are. I rarely would suggest leveraged ETF, and you won't hear me say it, but I will tell you that if you're an aggressive investor and you understand the risk and you understand the dynamics of those, I think there could be an opportunity for some of those leveraged ETFs, the bearish ETFs that have obviously not been a great general bet recently. And I think a lot of people are treating them as long-term holdings, which is just not how they were designed, and it's really not a great use of that vehicle. But I would say if you're seeing a potential drawdown, that there are going to be some leveraged bearish ETFs that will do very, very well based on a pullback. So that's probably where I would look initially.
Like Quid or SQQQ.
Absolutely, right. Some of those inverse sort of leverage ETFs, SQQQ probably comes to mind as a good one, given the volatility that you've seen in the Nasdaq and the pullbacks that have been a little more extreme than in the S&P. But the other thing I would say is I think as a trend follower, if you're not an aggressive investor, I think as a trend follower, you look at what's working and you stick with that. And I would be looking at sectors like real estate. I would be looking at high dividend payers. This has these stocks have decent dividends, and it's things like Simon Property Group, SPG, Iron Mountain, IRM.
A REIT?
Yeah, REITs are pretty boring and you probably never look at them. But if you look at the chart of real estate, which is what we're doing right now, REITs have been absolutely fantastic and they've performed well on an absolute basis, on a relative basis, and they have good dividends. And so I think in a period of market pullback, going to the relative safety of something like this could actually be a great way to ride something out. So I depending on how aggressive or conservative you would be, those would be the ways I would think about it.
Great ideas. It's kind of like a bond proxy in a way, isn't it?
That's right. That's absolutely right. Yeah.
All right, David, why don't you show us your website? And David, and I concur, David is not just a professional. There are many pros. He's a major leaguer. Okay, so so this is you could find David on Stock Charts. You do a little show there.
That's exactly right. So go to stockcharts.com if you're not familiar with what we do. Our job is to empower investors to make better decisions. And if you're interested in technical analysis, investor psychology, this is where we have a lot of great content. There's a free version that you're welcome to use. And then we have member versions, which have a lot greater capabilities. And my show, as you mentioned, Dale, which it looks like we'll get you on very soon, which will be a lot of fun to have you on my show. I'm on Stock Charts TV end of every day, our closing bell show. So check that out after the close. And then my YouTube channel is called Market Misbehavior. So if anything I described about technical indicators and I'm showing moving averages or Fibonacci retracements, you didn't quite follow it, go to my YouTube channel. I've got a lot of explanations of how to apply different technical approaches to different current charts.
You know, David, I want to thank you for really having a great demeanor for when people get emotional when they talk about money and markets moving around. Your demeanor even calms a nervous guy like me down. So I appreciate your analysis. I'm so glad to have you in the rotation, and hope that all your ideas turn green for you and all of your subscribers and followers.
I appreciate it, Phil. Be well. Thanks again for having me on.
All right, David Keller, everyone. And follow David at Market Misbehavior. He's got a nice YouTube channel there as well. So, you know, he's definitely a follow on Twitter for everyone that hears my voice, to get at least used to someone who has a discipline to, you know, keep you with what's happening in the market, not what you're projecting on the market. So thank you, David. You helped me today. So that's it, my trading warrior brother and everyone. I'll see everyone tomorrow. We'll wrap up the week. Good luck with the rest of the day. And remember, don't just count your shares, your coins, your crypto, count your blessings, and adios. Bye-bye. Same to you guys. You're welcome. You're welcome. David saying you're welcome. All right. Great interview, David. Adios.